Hi, Marvin. China's State Council just announced its once in a decade market reform guidelines to surprising little fanfare. The guidelines appear to focus on improving the quality of equity listings, but also measures to protect investors. Is this the main gist, and why should investors care?
Thanks, John. That's right. Overall, the aim of the guidelines are to kind of reduce the risk for investors by increasing the quality of listings of the A-share market over the medium to long term. There was actually quite a bit of excitement on social media platforms after the State Council announcement. Previous guidelines in 2004 and 2014 were followed by bull market runs in the following 1 to 2 years. But this year's announcement kind of got overshadowed by the Middle East conflict and the Fed noise over the past week. Our view is that the guidelines do address some of the structural issues in China's A-share market, which are indeed positive for the longer-term development, but it does come at a cost of short-term pain, particularly in the small caps, which may have more difficulties in meeting the new financial metric criteria.
And why are the authorities coming out with these measures right now?
So like many of China's industries, financial markets are facing a problem of oversupply, too many IPOs of potentially low quality companies that eventually become zombie listings. We've seen a wave of IPOs since the pandemic that has not really let up even as the markets continue to decline, and these IPOs are diverting liquidity away from the rest of the market. IPO volumes will likely come down dramatically while delistings will likely increase this year given the new guidelines. For example, stocks that have no earnings or with lower than 300 million yuan in revenue or are smaller than 500 million yuan in market cap may face increased delisting risks. So we think small caps will likely face more delisting pressure going forward.
And what are the financial market implications?
So large caps have been the main beneficiary of policy support this year, whether it has been the national team buying or the recent State Council guidelines. We've seen the CSI 300 performance outperforming the CSI 2000 this year, reversing kind of this multi-year outperformance of small caps. So these 300 or so large caps have been helping to maintain the perception that China markets are stabilizing. Overall, we think a flight to quality means that China large caps, predominantly high-yielding state-owned companies can continue to outperform small caps this year.
Marvin, thank you for your insights.
Thank you, John.